Good morning, everyone. It's good to start December with each of you. Thanks for Zooming in this morning for the annual Economic Summit. Unfortunately, like so many things this year, we are virtual. We are not in person, but like all great organizations and communities, we are flexible and we've pivoted to the Zoom format. I'm Megan Lucas, CEO with the Lynchburg Regional Business Alliance. And as we get rolling for the 6th Annual Economic Summit, I do want to give you a little bit of etiquette reminders. We go through a lot of Zooms. I understand that. And I want to ask everyone to please remember that our speaker is giving his time and expertise this morning. So please leave mute on unless you're speaking. Type your questions in the box using the chat feature, and then I'll be able to communicate to Tom your questions. Be present like you're actually in the real room at the event. So focus on the words of the interesting words we're going to hear from Tom. We have your video on, that way you are staying engaged in this morning's presentation. And please, by all means, share your experience today on social media, LinkedIn, any of your platforms that you use to network personally or professionally, as well as your networks. Please communicate with your friends and colleagues the value and you gain from this morning's Economic Summit. I'd really like to take this time to thank this morning's sponsors. BWX Technologies, our presenting partner, ABC 13, and Bank of the James, our signature partners, and Liberty University, Member One Federal Credit Union, Property One Photography, and Vista Graphics are our corporate partners this morning. Thank you for supporting the 6th Annual Economic Summit. It is community-minded businesses like yourselves that make our community a thriving hub of success. I'd also like to recognize our Chairman's Circle members, Framatome, Liberty University, Truist Bank, and Wells Fargo. Please join me at this point. I'm going to recognize the Regional Economic Development Team. We have, as most of you know, we call them the RED Team, the Regional Economic Development Team that comes together on a monthly and oftentimes more than monthly basis to work on economic development opportunities and initiatives for this region. And I think this is a group of heroes in our region who have been, like all of us, carrying a different load this year as a response to COVID. So please let me recognize Victoria Hansen, Economic Development Director for Amherst County, Sarah Carter, Economic Development, Town of Amherst, Waverly Cogsdale, Town of Alta Vista, Gary Shannonberger, Town of Appomattox, Tracy Bledo, Bedford County, Nina Rezai, Campbell County, Margette Upshur, City of Lynchburg, Stephanie Keener, Small Business Development Center, Ben Bowman, Central Virginia Workforce Development Board, and Jamie Glass. These are the members of the Regional Economic Development Team who are focused on growing and sustaining business and industry in the region. And all of them have been working diligently, especially with their great forward-thinking CARES Act grants and initiatives to support business and industry during this COVID time. So really want to thank each and every one of them for the hard work they do and the commitment that they have to business and industry in the Lynchburg region. We're fortunate in our region to have some significant allies. And this morning, it's my pleasure to introduce Rex Jeviden, President and CEO of BWX Technologies, and this morning's presenting partner. Certainly, we are thrilled to have BWXT in our community. And as I like to tell everybody, thanks to BWXT, the path to Mars leads right through our community. Rex, thank you for being here this morning, and the floor is yours.
Thank you, Megan, and good morning to everyone that's on the call. I do want to start by thanking Megan and her very talented team at the LRBA. Anyone who's met Megan knows that she's a tour de force, and we're grateful for her leadership in the economic development of this beautiful region, particularly during this challenging time. So Megan, we really appreciate you and your team. As for BWXT, this morning we're pleased to be the presenting sponsor for this year's economic summit, just as we were the previous 2 years. Many of you in the community will know that our nuclear components and fuel are used to power all the U.S. Navy submarines and aircraft carriers. And we are especially proud of that work, but we're also working on new technologies as diverse as nuclear medicine and nuclear powered space travel. It is our expectation and our plan to continue growing in Lynchburg as these new opportunities manifest. Generally speaking, in the area of economics, our businesses are sensitive to things like geopolitical conditions, electricity consumption, and medical procedure demand, but we are not insensitive to the more general economic conditions. Accordingly, I appreciate this annual LRBA Economic Summit because it brings us experts from beyond our region and provides an economic context for our businesses and their associated strategies. So I very much look forward to hearing what Tom has to say today in that vein. So I'll close by thanking all of you for joining this Zoom meeting today. We at BWXT wish you all the best as you finish up 2020 and prepare for a year of economic success in 2021. With that, I'll turn it back over to Megan.
Thank you, Rex. We appreciate you and BWXT's commitment to our community and certainly beyond. It's my pleasure this morning to introduce our speaker. Tom Barkin is the President and Chief Executive Officer of Richmond Federal Reserve Bank. He joined the bank in Federal Reserve Bank in January of 2018. In this role, he is responsible for the bank's monetary policy, bank supervision and regulation, and payment services, as well as oversight of the Federal Reserve System's information technology organization. Tom Barkin served as a voting member in 2018 on the Federal Reserve's Chief Monetary Policy Board, the Federal Open Market Committee. Prior to joining the Richmond Federal Reserve Bank, Barkin was a senior partner and chief financial officer at McKinsey & Company, a worldwide management consulting firm. Barkin oversaw McKinsey's offices in the southern United States and provided strategic counsel to a diverse portfolio of clients. Barkin also served on the board of directors for the Federal Reserve Bank of Atlanta from 2009 to 2014 and was the board's chairman from 2013 to 2014. Barkin is a member of the Emory University Board of Trustees and Greater Washington Partnership. He earned his bachelor's, master's, and law degrees from a small university known as Harvard. Please welcome Tom. Tom, the floor is yours. Good morning.
Thanks so much, Megan. And thank you also, Rex, for your sponsorship here. And I appreciate everyone joining. I do wish I could be with you in person, but I'll try to bring some of the energy, at least over the Zoom call. This is an interesting time of year. People like to look forward and talk about what's going to happen next. And so I'll try to do that. I should probably hold myself accountable. A year ago, when asked the question, what was going to happen next, I said that recessions don't.
I think we've lost Tom. Can everybody hear Tom?
Nope.
Tom?
No, Tom, you're muted or something.
1 second, Tom.
Can you? I'm sorry. Can you hear me?
You're back
Yes.
now. We're back now. We lost you at Recession.
Okay. Well, that's too bad because I really said something funny and nobody laughed, which is disconcerting. But I think that was, I got a phone call coming in and it somehow messed with the call. Okay. So the question I had last year was, is a recession around the corner? And my answer is that upturns don't die in old age. I have a heart attack. And unfortunately, I just had the wrong disease. I mean, this has been a terrible, strange year. And I thought it might just make sense to take a look back before I take a look forward and try to articulate what I think's happened this year. These are my views, not that of the FOMC or the Federal Reserve System. And I say that because it frees me up to be as direct as I want to be. And so I'm really looking forward to your questions, and please do input them as we go. My background is different than most of the other guys in the room at the FOMC. It's a business background, not a research background. So hopefully you'll find some of my views relevant. So a couple things that I think really benchmark the year we've had. First, you guys all know this, we shut the economy down in April. And when you shut the economy down, spending plummets and so does jobs. And we've talked a lot over the last 20 years about this issue with the shrinking number of middle-class jobs in our economy and the growth in both the higher end and the lower end. And sadly, this recession targeted the lower end of that barbell, the personal service jobs that are disproportionately young, disproportionately women, and disproportionately people of color. Now, the second thing that happened is that the economy reopened in May, accompanied by extraordinary levels of fiscal stimulus. Just for context, after the Great Recession, we had a big argument about whether we should get to $1 trillion in fiscal stimulus. We actually had in March $1 trillion package followed by a $3 trillion package. And that fiscal stimulus has been incredibly helpful to a bunch of people who were laid off. It also led to a huge increase in our savings rate because personal income, which is the combination of what you make in your job and what you get transferred from the government, is actually up 3.3% this year. That's at a time where, you know, we've had unprecedented unemployment. And that's, of course, because of the enhanced unemployment benefits and the direct distributions to households. At the same time, people like me who were able to keep their jobs and shelter at home found that their spending declined dramatically. We weren't going out to dinner, we weren't taking trips. And so we actually saved a bunch. And that happened across the country. The savings rate in this country, which is normally around 8%, was 26% in the second quarter. And it's still almost 14% today. Now, those who had elevated savings couldn't spend on services the way they used to. So they paid down their credit cards. You know, in a recession, you wouldn't expect credit card balances to go down, but they actually have. And we rotated our spending toward goods, and particularly any goods that related to time at home or recreation. So furniture, patios, home and garden, painting, carpets, boats, RVs, all of the golf clubs, all of those categories sort of went through the roof during the summer. Durable goods spending is actually up almost 13% versus the levels pre-COVID, while services spending is still down 7%. And manufacturers, for the most part, have benefited from that. And I'll take oil and gas and aerospace aside, but other manufacturers have really benefited. Our survey of manufacturers in October hit its highest level ever, right? Low rates have probably also helped. And if you look at interest sensitive sectors like residential or automotive, they're also booming. Home builder confidence is also at all-time highs. Single family housing starts are as high as they've been since before the Great Recession. In the third quarter, we saw GDP grow at 33%. Now that's a quarter over quarter number, which is of course inflated by the fact that the second quarter plunge was so steep. So maybe a better way to look at it is pre-crisis versus today. And against that, GDP is still 3.5% below where it was pre-crisis. Now spending, that 3.5%, is coming back faster than employment. So the nationwide unemployment number you see continues to drop. It's 6.9%. But remember, you know, before COVID, it was 3.5%. And the way I like to look at it is jobs are still down 6.6% versus pre-COVID levels. And that's actually worse than the depths of the Great Recession, which was 6.3%. So as much as we've come back, we've brought back, I think, 11 million jobs. We're still worse than we were at the depths of the Great Recession. Now, what's going on there? Well, there's a part of it which is businesses. You've got businesses running at constrained capacity, think movie theaters or amusement parks or restaurants. You've got others that are understandably cautious and have taken the opportunity to streamline their operations. But you've also got issues on the workforce side. Labor force participation has dropped from 63.4 to 61.7 today. To put it differently, if you kept participation constant, our unemployment wouldn't be 6.9%, it would be 9.4. And that's particularly hitting women. Their participation has lagged men. And you have to imagine that escalating care responsibilities at a time where childcare and schools may be closed or remote, and elder care facilities are perceived to be less safe, are just making it difficult for people to commit to work. At the same time, you've got a labor market mismatch. I'm still hearing from employers, particularly in manufacturing and technology and healthcare, that they can't find workers, even though we've got, participation adjusted at 9.4% unemployment rate. And what's going on there, I think, is a mismatch. You've got a set of lower income service workers, think waiters or bartenders, who don't really have the skills for those jobs that I just talked about in technology or healthcare or manufacturing. And many of them are frozen in place, not yet ready to move on or invest in training for their next job, given the uncertainty around the virus and the possibility that, 6 months from now, we may have a vaccine and everything will be back to normal. An interesting piece of evidence for this lack of mobility is community college enrollment. Now, community colleges play a great role in terms of helping people move from one job to another through some of these certificate programs. But unlike four-year schools, their enrollment is actually down and down significantly, probably due to this uncertainty or a lack of comfort with online schooling or challenges with childcare or the like. So let's take a look forward. We've been talking about uncertainty all year, but I have to say for me, and I know it's risky to say this, I actually think the future's come into somewhat clearer focus, both for good and for bad. On the virus front, I'd hope the virus would be behind us now, but if you look at the recent escalation in cases, it's now over 170,000 a day, a 7-day average. As referenced, the prior peaks were 32,000 a day in April and 67,000 a day in July. Just makes me believe we've got a ways to go. Governments may well be reluctant to shut the economy down again, but consumers have the ability to do a lot on their own. And while I haven't seen much evidence to date that spending has dropped, I see it flattening, but not yet dropping. I do see consumer sentiment flattening, and so that's something to watch carefully. On the positive side, we now have a couple vaccines that seem to be proven effective. They're likely to be approved sometime before year end, which will give us some daylight on the horizon. But as best as I can tell, a broad enough rollout to make us all comfortable fully interacting in personal commerce again is probably sometime this summer. On the fiscal side, regardless of what happens in the elections in Georgia, I think you're going to see divided government. In other words, very hard to go, all the way one direction. And many businesses like that. They like legislative stalemate because they believe it promotes the certainty that supports investment. On the other hand, when it comes to fiscal stimulus, we may see a little something at the end of the year, but it seems much more likely that we're going to be revisiting fiscal prudence over the coming months as well. Many people ask about inflation, but I'll just say inflation's hard to find in the numbers. Over the last 10 years, it's averaged 1.5%. The price level actually fell in February through April, then rebounded over the summer, especially for items in short supply, like food or lumber or cars. But it's moderated recently, and over the last 12 months, it still remains at about 1.4%. So what does all that mean for 2021? I do see promising signs for business investment as uncertainty comes down, as I suggested earlier. And that's probably supported by our accommodative forward guidance in monetary policy. You can see positive signs, for example, in last week's strong durable goods report. In contrast, I think the spike in government spending is probably behind us as the country moves to divided government. The key question then is on the consumer side, which of course is 2/3 of the economy. And here I want to come back to the elevated savings rate. There's a lot of money in people's pockets that's cushioning the cessation of fiscal stimulus and could propel the economy at some point. I saw a recent estimate sizing the excess savings at $1.25 trillion and suggesting it was relatively equally held among income quartiles. Now, the last time we saw a savings rate like that was World War II, when rationing limited spending, not unlike today. The post-war years saw huge spikes in consumption. And I guess the question is, could we unlock similar pent-up demand next year? Now, while I certainly hope so, I see the savings more as a backstop than as a stimulant. So in the first half of the year, if the virus surges and fiscal stimulus ebbs, these savings, remember, half of them are held by the bottom half of income in this country, are going to be essential to support spending, particularly for goods, and to enable the less fortunate to cope. In the second half of the year, while I do expect some post-vaccine resurgence in demand, I mean, I know I would like to go out to a restaurant or take a vacation or even take a business trip. services like that generally don't yield themselves to significant volatility. You can't make up for a missed haircut or a missed dentist appointment or back vacation days. And the wealthier, half of the country, who will then have most of the savings, generally take a longer term mindset on their spending. So my outlook is a slow and steady recovery, but one with most of the downsides backstopped. You might say we took the elevator down, but we're going to need to take the stairs back up. And with that, let me close. And Megan, I'm open to any questions and comments, and happy to hear what you guys are seeing in Lynchburg.
Thank you. Always making a note. We took the elevator down, but we'll have to take the stairs up. And that's really a good quote. And I'm out of wind just thinking about taking the stairs up. I suppose the question is, how many flights will we be traversing as we move forward?
I know you're being metaphorical, but I'll try to answer. One of the really interesting things about this downturn is how different it feels based on where you sit. So, I talked about the people who've lost their jobs versus the people who work at home, people scraping to get by versus people who all of a sudden, finding that their spending's been curtailed and they're saving more. But you could also say that totally by industry as well. If you serve the federal government over the last year, you probably haven't been hit much at all. On the other hand, if you hit state and local governments, you've probably been hit pretty significantly. Obviously, if you're in a restaurant or a bar or a theme park or a movie theater, this has been really rough. If you're an auto dealer, you feel like things are great. If you service the airline industry or oil and gas, you think this has been, very tough. But I can't tell you, if you're talking to Lowe's or Home Depot, or you're talking to people who manufacture cabinets or carpets, you feel like their business is through the roof. So I think it's really hit sectors massively differently. And so the stairs back up differ a lot based on where you start.
That's right.
Or where you sit.
And I wonder about the difference between urban and rural. The Lynchburg region, certainly we are, the city of Lynchburg is our dynamic urban hub, but we have a thriving rural ring, which is significant in ag. And I wonder if you have any thoughts and perspective about, urban versus rural.
I do. And you may know I've got a lot of passion for the smaller towns in our district, because one of the things when I started my job is I looked at, where do we have the best employment outcomes and where do we not? And what it looks like is actually in the cities and the suburbs, employment to population is 10 points higher than in the smaller towns. Now, that's not true for every smaller town, but that's something we've dug into quite a lot. And I think, as I suggested, this sort of historic mega story that has, U.S. manufacturing dropping and real growth in these service industries, it's being challenged by this virus. I was in Hickory, North Carolina, which is a big furniture hub. I know there's a lot of that in Southern Virginia as well. Furniture manufacturers are thriving and frankly can't find workers right now. And it's understandable. People like me have been sitting home and recognizing that their furniture isn't that comfortable or that suited for their needs. And they've gone and, been upgrading. And a lot of manufacture like that is actually coming back quite strongly, which is, I think, really good for our economy and really good for the small towns in our economy. The agriculture side's a little messier, honestly. It a little bit depends on what you're growing. But you've obviously had downs and now ups vis-a-vis China and the tariff wars. And so, you actually have very strong demand now as China's, meeting some of their commitments, but you had a long period of time that was not that strong. You've also had the significant dislocation between food at home and food in restaurants. And so depending who you produced for and where you produced, those folks who've been going into the restaurant sectors actually had a very tough year. Those people who went into grocery stores actually had an incredibly good year. Again, back to my point, which is how you feel about this depends on where you start. And then I'll just say that, another mega story that people talk about is the big cities versus the small towns. And, I get why San Francisco or New York were pretty exciting destinations before getting on the subway looked like taking your life into your hands. But I just think it's worth taking a step back, and we may well see some migration from bigger to smaller. If we do, which I think we will, smaller towns do have to then stop and say, well, then why would my smaller town be the place people would go? And so you clearly have to get yourself wired, because all the stuff we've talked about doesn't work if you're not in a wired destination. You've got to work on amenities and other reasons for people to live there, because, in Virginia, you're competing against, Winchester and Harrisonburg and Charlottesville and a lot of other very attractive places.
Thank you very much. All right, I have some questions for you. First one, why is the stock market done so well with these tough times? Doesn't that exacerbate those that are winning versus losing and the income divide?
Yeah, so obviously, for a really good point of view on the stock market, you should go to someone who knows something about the stock market. So I'll warrant everything I say first that I don't know that. I'd say there are a couple things going on that are pretty obvious. One is we took interest rates down to zero and made clear that they would stay there for some time. I think if you were a bond investor not getting any yield, you might have stopped and said, well, I want to think about where my investments go. And so I think there has been some rotation of funds from bonds into stocks. And so there's a flow of fund situation. Yes, there are downsides in stocks, but there are also upsides. And, you might get a dividend where you weren't with treasuries. The second thing that's pretty straightforward is the stock market, by and large, is big companies. And big companies have done a lot better than smaller companies in this downturn. And so the stock market isn't all of business. It's, if you will, all of big business. And so that's the second thing that's going on. The big companies might have had the financial wherewithal to survive it, and a lot of smaller businesses have struggled. The third thing is that a huge part of the market cap in the stock market is actually these 5 big internet stocks, which have prospered massively, Amazon or Google or Facebook, during all this remote work from home. And so it's disproportionately driven by a few companies that are there. So that's what I'll talk about in terms of the stock market. I think when it comes to bringing back the economy, again, I go back to, and I'll oversimplify by saying the sort of wealthier half and the less wealthy half of the country. As I said, both of those groups in total, I'm not talking about every person, both of those groups are significantly stronger, have significantly stronger personal balance sheets right now than they did before the downturn. The wealthier half in part because of the stock market and the fact that they're spending less, the less wealthy half because of all this stimulus money we've put in, the enhanced unemployment, the direct distributions to households, and the fact that they too are spending less. I think one of our challenges for the next 6 months or so is, if you buy my base case, which is we're not going to have another huge stimulus program, then the people in the top half are going to continue to spend less and save, and the people in the bottom half are going to spend out those excess savings and get significantly closer to the edge. And that's something, if we don't extend unemployment benefits and the like, that we all need to be very attuned to.
Thank you. Tom, do you believe we will have permanent structural changes in the economy as a result of the pandemic?
I have to say, I'm a little, I always start from a position of skepticism on the word permanent. I was in a consulting world in 9/11, and we convinced ourselves we were never going to fly again until 3 months later, the TSA came and we all flew. And so I don't think of things as, being permanent for the most part. That said, clearly you've accelerated some trends that were already underway. Online shopping would be a good example of it. Takeout and delivery would be another trend. Telehealth would be another one. And I think having tried it and, found them to be reasonably attractive, people aren't going to go backwards. In our shop, we actually had a bunch of policies that said you couldn't work remotely. And frankly, technology that made it difficult to work remotely. And I can't imagine, we or most anyone are going to go backwards in terms of enabling that kind of flexibility. But in terms of whether all this is permanent, I'm pretty skeptical. I think humans have gotten together historically for a lot of good reasons, including social needs, but also including, business gets done better. And so I do think people are going to, convene again. That's in part because I don't believe we're going to have, a plague around us for another 5 or 10 years. I think we're going to put it behind us. I think we'll have learned a bunch of stuff in the same way, I mentioned airlines at the beginning. You forget that before 2001, we all had to check in person and stand in a very long line. And they had kiosks before 2001, but nobody used them. And so in 2001, we all started using them, and they rolled them out and they forced us to use them. And then they went to mobile check-in. And so now all of us can fly, in a much more efficient way. And I think that's the kind of thing we'll see. Enhanced adoption of stuff that's frankly of good value and that we may have been hesitant to use before. That's the kind of structural change I anticipate.
I think we're seeing that in the region as well. What effect would tax increases on the wealthy and possibly some increase on corporations have on our recovery?
Well, first of all, if you buy my scenario that we're going to have some version of legislative stalemate, even if it's 50-50, I think there'll be some version of it, then I think that's probably a lower likelihood than it might have seemed for people who thought, you'd have a different legislative outcome. The economists are pretty clear when it comes to, taxes, that taxes on the wealthy obviously, send money to government. And so it depends on how they're used. The wealthy don't have a high propensity to spend, if that makes any sense. Those who are less wealthy spend every dollar they have. Those who are wealthy, tend to save. And so the analysis wouldn't suggest a big economic negative to increase taxes on wealth, particularly if that money is then spent in another place where there is a high multiplier. But of course, it's always the devil's in the details. And in the 50s, taxes on the wealthy were marginally at this kind of level. And, today they're here, and, yesterday they were there. I mean, so a lot depends on where you go when you do those analyses.
Thank you. We've had a question. Where can we find the durable goods report you mentioned? Is that on your website?
I don't know if it is. Just Google latest durable goods report, and you'll see it. It came out last week.
Okay,
Monday
perfect.
or Tuesday.
Thank you. How do you see the recovery for state and local government capital spending capacity? The reduction in tax revenues have hit their budget significantly at this point.
Yeah, I think this is a really important issue. And first of all, not every state and local government is the same. Some of them, think your normal school boards get most of their money from property taxes. And if you get most of your money from property taxes, actually, you're just fine. House prices are up, sales are strong. And so those governments that are heavily leveraged to property taxes are in a pretty good place. On the other hand, if you're highly dependent on restaurant taxes, like the city of Richmond is, then you've got some challenges. I talked to another city recently that decided to, for a bunch of obviously thoughtful reasons, decided to not collect certain utility payments for a period of time for people who were in need. Well, now they're looking at their budget and saying, holy cow, we didn't collect all those utility payments. We've got some issues. To the extent you're dependent on income taxes, personal, corporate. I mean, so I think the revenue mix is going to be very different by city. If you are one of those cities that are constrained, though, and a lot of them are, then I think you're going to see a real risk that we cut services. And in particular in states that have to balance their budget, these service reductions, which is really what states do, is services, are going to be a real challenge. On the capital side, it totally depends on where you start. That it shouldn't be hit by, given your income, your capital spend. But I've talked to a bunch of people in construction who would suggest institutional spend is being delayed or cut back, in part, I think, because you've got people worried about the financial wherewithal of their community and are making those choices. So I do expect to see some cutbacks there in the places that are vulnerable because of their revenue structure.
Is the FOMC considering that some businesses have closed and or reduced staff nationally using COVID as the excuse, but it truly has nothing to do with it? If so, is it a factor worth considering in monetary policy in the near future?
Well, I should say just, from an FOMC perspective and monetary policy, our levers are reasonably simple. We take rates up or we take rates down. And that's a broad brushed, set of tools as opposed to something that's very tailored to particular industries. We do focus, part of our mandate is maximum employment. So we do focus on what's happening in labor markets. And I don't know if I'd say it's an excuse, but I do agree completely with your premise, which is we've had a shutdown that has put a bunch of people out of work temporarily, let's call it. It has also threatened the viability of a bunch of businesses, particularly small businesses, over the long term. And certainly when it comes to restaurants and bars, we've seen a lot go out of business. So there's a lot of workers who've been laid off against that set of dynamics. At the same time, as I said in my talk, I think there are a bunch of businesses who are cautious and have said, the world is uncertain. We don't know what's going to happen. Let's streamline our workforces. And so as I talk to the bigger companies, even those that haven't lost a lot of revenue, I am hearing a lot of talk about streamlining workforces. That's 5 or 10%, not 20 or 30%. But that's still a lot of people laid off. And so I think as you look at the 6.9 or the 9.4% unemployment or adjusted unemployment that I talked about earlier, that includes both segments. And when we think about maximum employment, we think of what does it take to bring both of those segments back into the workforce.
Gloria Witt, her question's right in line with the workforce discussion. What will it take for employers to start hiring unskilled workers for potential and grow their workers with internal training and mentoring?
Well, it's interesting. We were at 3.5% unemployment before all this started. And I started, 3 years ago. And I heard employers tell me I can't find any workers. And I think we saw a lot of evidence in the last couple of years that we were bringing a lot of workers who were not otherwise employable into the workforce. I talked to a bunch of community colleges that are doing partnerships with companies to try to target specific skill sets and train those people. I mentioned being in Hickory. The community college there has a great program in terms of bringing people into the furniture industry. And so I think we were finally getting to the point where those investments were being made, if you will, the last people into the workforce were actually getting into the workforce, getting trained, getting jobs. And of course, that was a very attractive part of the economy we had at the beginning of the year. Like I said, the dynamic right now is a little strange. I mean, we have 10 million more people unemployed than we did in February, yet I am talking to people who can't find workers and are complaining about the need to pay more money for those workers. And, in economic theory, that wouldn't happen. In economic theory, they'd find the workers and you would trade, you'd go. And so I really do think what's going on is this combination of things I talked about, which is a certain number of people leaving the workforce for health or childcare concerns. You've got a bunch of people frozen in place who may have been laid off from their job, but that's the job they wanted or knew how to do. And that job may come back just any month now. I'm thinking of somebody who worked at a movie theater, right? Who maybe that's what they wanted to be doing. And the movie theater will open, Wonder Woman 84 is coming out in 3 weeks, or maybe it's not, that kind of thing. And so you'd like to think that they would retrain and get into furniture manufacturing, but it's not obvious to them that's what they want to do. And it's not obvious to the furniture manufacturers they have the skills. They could do it, but you have to get them there. I should add there's a geographic component to it. If you're in Virginia Beach, you may or may not want to move to Hickory. And so, there's also, when does this get, how would I put it? When does this get severe enough that people need to make those choices? Remember, we put a very strong bridge in place through the enhanced unemployment and the direct distributions. So some of these people haven't had the financial push that says they have to go do something. So they've been bridged for a while. But that's where I say, in the first half of this year, it's going to be interesting because, folks who've been bridged are going to bleed out the savings. And actually, there is a point there where people will hit the wall. And some of these, matches will get made that maybe otherwise haven't been getting made.
Yeah. Thank you. From the email, I've got questions. I've got questions coming at me from all directions this morning. Housing for millions of Americans seems to be in a precarious position, and really in a grace period as to evictions and foreclosures. How likely will there be significant disruptions in housing for 2021?
Yeah, these are all good questions. So there's a lot going on in housing. And, I'll start at the high end and then go to the low end. At the high end, you've got a market which collapsed in 2008 and has built back very slowly since then. And this year has actually all of a sudden spiked again. And so what's going on there? Well, people have been locked in their house. There's nothing like being locked in your house than to see the flaws of your house. And so people have decided to upgrade their house. That's one thing that's going on. The second thing that's going on is the millennials famously for the last 10 years haven't been buying houses. Well, guess what? They now have 2 kids and the apartment's too small. And so now they're looking at houses. So you've got a demographic piece to it. The third thing is you've got a bunch of people who are living in multifamily situations in DC or New York or San Francisco who all of a sudden with some clarity see why they don't want to be in multifamily situations and are trying to get themselves a little more space. And mortgage rates are very low. And so all that has created significant demand for houses, back to the level of before the Great Recession. At the same time, you can't manufacture houses immediately. So the supply is constrained. I think the inventory right now of houses is as low as it's been in my memory. It's like 3.3 months or something like that. And so you've got really strong demand combined with really constrained supply. That's a very tight housing market. And that's true, for those, single family houses pretty much everywhere in the country. So that's, let's call it houses. At the same time, then you've got these multifamily situations. You've got a bunch of people at the low end who are in their rent situations. They're not owning houses. It's a totally different kind of situation. And we have, in fact, by legislation and in many states otherwise, put eviction moratoriums in a way to help people get by. And I've tried to study this because it's a pretty strong intervention in the market mechanisms. And on the positive side, it has created some space for some people close to the edge to be able to survive over this period of time. On the downside, the rent obligation doesn't go away. And so on the back end, there's a negotiation with the landlord that says, okay, now, the government has stopped intervening in this and you now owe 8 months of back rent. How are we going to handle this? And as you well understand, most people can't just come up with 8 months of back rent. And so how that plays out on the back end is going to be really important for these people. And I think really important for the affordable housing space, because, we need to not put a bunch of people on the streets. We also need to not take a bunch of housing out of the equation because people can't collect the rent on it. And so states are going to struggle with this. Eviction courts do not move quickly. And so I think this is the kind of overhang that could be with us for some time.
Okay, thank you. Do we still have a free market economy? Healthcare is 8%. 6 large firms have market cap equal to all of Europe. Every part of everything we make is regulated. Free market requires a large number of demanders and suppliers, and this does not seem to be the case anymore with monopolists all over the map. If we do not have markets, what does the Fed do? Great question. That comes from David Bratt, the Dean of the School of Business at Liberty University.
Yeah, it certainly sounded like that. So I took a great course in college called The Economics of Regulation. And the first thing we did was we read Adam Smith, Wealth of Nations. And the professor started the day by saying, what are the core 7 assumptions behind capitalism? And those core 7 assumptions were fragmentation of buyers, fragmentation of sellers, no transaction costs, low barriers to entry, low barriers to exit, perfect mobility of capital, perfect mobility of labor. I think I actually got those 7 right, which is pretty good for 35 years later. And then he said, okay, name one of them that's true in real life. And the fact is that none of them are true in real life. And none of them have ever been true in real life. And the system we've had, since Adam Smith has been something that has aspired toward pure capitalism, but has never quite been there. And the challenge is, do the interventions that governments or market actors make in that system work toward this greater good, or do they work against it? And I think that's always the challenge we've got. There's a really good book that's been written recently by a guy named, I think, Thomas Philippon, or it might be Phillipson, who's a professor in New York, about market power, and makes the case that you've got significantly more market power in the economy than you used to historically, and that that market power, while it may have some benefits for consumers, also works negatively in a bunch of other ways, including, he would argue, capture of certain government entities through lobbying. There's then a whole another theory about regulation and where it works and where it doesn't work that I think is also, really worth pushing on. So, we have thousands of interventions in what otherwise would be a free market economy that work plus and minus. And I think the question you always have to push on is, at what point do they, help support and balance against the pre-existing situation? And to what point do they inhibit, the greater good? And I think it's a very fair challenge to the economy we've got. But I just would make the case, I don't think we ever had what Adam Smith, the Adam Smith ideal.
What kind of work is the Federal Reserve doing with cryptocurrencies, especially Bitcoin, which is beginning to see big money enter this new asset class?
Yeah, so let's talk about Bitcoin for a second. I like to say I get the questions I get on Bitcoin are directly correlated with the price of Bitcoin on a given morning, and I think it was over 19,000 today. So I was expecting it. The question. So the Fed has obviously said we're going to monitor this question of digital currency and whether it's something that we ought to have. And we've got tests and experiments underway. We've been public about that. The question of digital currency, to me, is it's a bit of a mystery to me in the following way. I'm trying to find what problem we're trying to solve, because I actually think we have a digital currency today. It's called the dollar, or put differently, I've got $80 in my pocket, and I've got more than that in a digital ledger in a bank. And so, I actually have digital currency. If I would like to pay someone digitally, I do that via Zelle or Venmo. The Fed is developing a FedNow product, which would do it actually instantaneously. And so, I am curious about what problem we're trying to solve. Some people will talk about, providing something for the unbanked, but of course, you don't have to have a bank account to have Venmo. Some people would talk about international transactions, which I agree are inefficient, but it's not obvious to me you have to start a whole new currency to handle the inefficiency of international currency transactions. Some people talk about a stable store of value, and that may be the best story I've heard, but it's really a good story if you're in Argentina, where you've got a currency that's not very stable, and you may want something. Today they use the dollar, but maybe you'd like to diversify into gold or Bitcoin or some other asset class. But the dollar is pretty stable here, so it's just not obvious to me what the use case is, what the value proposition is here. But like I said, it's something we're definitely studying and continuing to study.
Thank you. What do you see as the future for the various monetary lending backstop facilities, such as corporate bond facilities, particularly given the recent action by Treasury Secretary Mnuchin?
Well, we have certain authorities that are given to us, by Congress in our charter. And those include things like, buying treasuries and buying mortgage backs, quantitative easing, as it was called in the last downturn. The Dodd-Frank Act made a change in these emergency facilities, and it said they can only be done with the consent of the Treasury Department. And we're not allowed by our charter to take financial risk with them, rather than lose money in them. And so to the extent that you want to take any risk in these facilities, there needs to be a backstop funding, which comes from the Treasury Department. In the CARES Act, Congress allowed, given the circumstance at the time, that they would support the creation of a set of additional backstop facilities, which we stood up in the late spring and summer. And those facilities expired December 31, and the Treasury Secretary, who has to agree to do any of those facilities, made clear that he did not want to extend them. And so, because we operate only with the consent by Dodd-Frank, if he doesn't want to extend them, then we don't extend them. So that's that for those facilities. He did approve the extension of 3 or 4 of them, which there's a money market backstop fund and a couple others that have now been extended for another 3 months, I think. In terms of what the future is, I think it depends on what the Treasury Secretary wants to do. It depends upon the needs that we might see in the market. These are backstop facilities for market dysfunction. So think of them as a risk management kind of structure, as opposed to something that's sort of putting money into the economy aggressively. I think they're more backstop facilities. So, we'll see what the Treasury Secretary wants to do. And importantly, what funds they want to put behind it, or are able to put behind it to, fund whatever losses we might take. So we'll see where we go with that.
Tom, I have one final question. Some say that the United States has a debt problem that is set to explode as growth in deficit spending far outpaces corresponding growth in productivity. How substantial is our national debt problem that includes governments, businesses, and families?
Well, I guess I have to take the 3 of them separately. I'll start with the government side, and I do agree with the premise. Debt to GDP was 38%, I think, in 2007. It was 80% at the end of 2019. It's now projected to go, at or just over 100% by the end of 2020. There's nothing urgent about that. There are countries like Italy and Japan. Italy's probably at 160% of GDP. Japan's at over 200% of GDP. I don't aspire to be either one of those, but a country there's no one number at which a country wakes up and says, oops, we've got too much debt. But it's like that character in Hemingway who, when asked how he went bankrupt, said gradually and then suddenly. There's some point out there, some mysterious point out there where your creditors no longer want your debt. And when that happens, interest rates spike, and that's obviously restrictive and destructive for an economy. And so, I think this is the kind of thing over the medium to long term we do need to take seriously. I would add, there was a great during the Tea Party situation. There was a great Today Show episode where they had 8 people around a table. They had a Tea Partier, they had a student, they had a retiree, they had a union member. They had sort of one of every segment, and they gave them a bunch of flashcards in terms of how to balance the budget. And they did it in 20 minutes on the Today Show. And I say that not because it's doable in 20 minutes, but because I think the levers are not as painful as we think they are to get it under control. They're not about cutting stimulus today in an economy that's struggling. It's about setting yourself up for the future in a thoughtful way. But it requires political will to get there. And obviously we've struggled to get that together. On the personal side, we had our problem on the personal side in 2008. Actually, personal balance sheets have come down quite significantly, including in this crisis. And so, at least by historic levels, I'd say personal debt levels in this country are not elevated. I might exclude student lending, which looks like a difficult situation right now. But outside of that, personal balance sheets don't appear to be quite as extended. I do think corporate debt is quite significant, and it's at historically high levels. And that's something, I watch carefully. Rates are low right now. It doesn't look like you've got defaults out of range, but that's definitely something worth watching. And, I just think one of the challenges you have for the FOMC is you take rates down, that obviously incents leverage. That's not a bug, that's actually a feature. You're trying to get people to borrow and spend to bring the economy back. But you would like to think that they believe there's normalization on the horizon so that they are responsible in the debt that they take. And that's obviously something we've got to watch carefully as well.
Tom, thank you very much. On behalf of the board of directors, We really, Board of Directors of the Lynchburg Regional Business Alliance, we really do appreciate your time this morning and that you joined us, and certainly virtually makes it easier to do, but we look forward to a time when we can host you in our wonderful region in person so you can get to know us. And I will send you Dave Bratt's contact information so that the two of you can connect and have some good discussion about China and Adam Smith.
Okay, well, I would love that.
Yeah, the Alliance aims to grow the region's prosperity and global connectivity. The Alliance works collaboratively with regional partners to recruit and assist new and expanding businesses to ensure that a talented and educated workforce delivers valued skills, to pursue policy that benefits the economic vitality of the region, and to promote the region to national and international audiences as a vibrant place to grow and thrive. Through our areas of work, the Alliance contributes directly and meaningfully to the vitality of members and investor businesses and the quality of life for the entire region. All of this creates a true alliance between business, government, and the public to fulfill the Alliance mission and vision. Our regional economic development efforts are supported by accelerating our future economic development campaign, which is the 5-year funding campaign that provides funding to execute our regional economic development strategies. And I know that the print is small, but if you pay attention to the slide on your screen, I want to thank each of the businesses that have targeted their commitment to regional economic development, growth, and prosperity. We really appreciate all the businesses and industries and the localities that support regional economic development initiatives. Certainly this year, we have pivoted. There's that word we hear so much of, standing up a business COVID task force with regional partners, having regional roundtables with industry sectors, having weekly meetings with Centra and educators, advocating aggressively for our businesses and industries that call the region home. Even in the COVID world we've experienced over the last 12 months, our region has seen an increase in prospect activities of greater than 27 companies looking to grow into this region. We have expended and are expending well over $400,000 on site improvement, working with our local economic development partners. And of course, living our core values, which include going beyond the business card, really working one-on-one with businesses to help them connect with other businesses, but really manage the hurdles that have been put in their place. I appreciate everybody for attending this morning. Once again, I'd like to thank BWXT, our presenting partner, ABC 13, and Bank of the James, our signature partners, and Liberty University, Member One Federal Credit Union, Property One Photography, and Vista Graphic, our corporate partners. The Virginia Chamber of Commerce this Friday, December 4th from 9:30 to 12 will be having their annual Virginia Economic Summit and Forum on World Trade. We have 5 complimentary tickets, so if any of you would like to attend that, please send an email to me today and we'll get you registered for that. Again, that's a virtual Virginia Economic Summit Forum on World Trade this Friday from 9 to 12. You'll see upcoming events for the Alliance, opportunities for you to engage and expand your professional network. December 3rd, ribbon cutting with Divine Fog, a ribbon cutting on the 4th for Dot Drives, our virtual AM Alliance this Friday, ribbon cutting for Mass Mutual, pancakes and politics. Now more than ever, advocacy is continuing to be very critical to the success of our business community. So please join us and our area legislators for pancakes and politics on the 17th. And you'll see we're already planning into the new year. The Lynchburg Regional Business Alliance is here for you. Your business is our focus. Thank you, Tom. Thank you to our sponsors, everyone. Please be safe and remember to shop local and support local. Have a great day, everyone.